Hello and welcome to this new edition of BCR Webcasting. And today we're going to be talking about some recent news just announced yesterday of 40Cs, a new fintech company, relatively new fintech company, who've just raised $11 million in seed capital and have also managed to get a $100 million credit line in place. So I'm now joined by Igor Zaks, who's the co-founder and chief risk officer of 40Cs. Igor, welcome.
Thank you, Michael.
So just to give us some background, would you please, Igor, to 40Cs and why you think cross-border financing is a good market to be in at the moment?
Sure. So first, a little bit about 40Cs and where we started. So the company started in February of last year. We get a founding teams that are all very experienced entrepreneurs. So it's Io Moldovan, who used to be in the payment space. So he was a general manager of Payoneer, one of the leading payment service providers. Joe Schiff, who came from advertising space and also have successful exits before. And Sukigawa, who is based in China, and she was with Ant, PayPal, and again, a lot of fintech experience. And myself, and I've been in this industry for many, many years, as Michael knows. We were supported by Team 8, that's one of the top VCs in Israel, with a lot of investment in cybersecurity, fintech, and other areas. And also, another investor of ours is Zim, that is one of the biggest shipping companies on this planet. And Zim also provides us, as Michael pointed out, a credit facility. So uh, now, in terms of the space, there are a few things. So I don't need to repeat what everybody is telling. And historically, I was one of the first people who start telling about these numbers in terms of trade finance gap and the overall size of the market. So there is a very big need for funding of cross-border sales. It's also a lot of intercept between the logistics and trade that is also important, and that's one of the good reasons for our existence. But the real part of it is there are segments of this market, the segments of cross-border sales that are relatively well served. So there is a traditional ways like letters of credit, whatever, that is a shrinking market but still exists. There is obviously a supply chain finance that is done by banks, but they're done typical for a very large and typical investment grade buyers. Now, what we get a very, very significant market when neither the buyer nor seller are massive. And and in this type of space, it's a little bit different task. So you really need to be able to access the credit, but also what is very important is operational side, because you really need to be highly integrated, and that's a service people value. So if you service, $100 billion company, really they can combine various parts and do various things themselves, and it doesn't really matter how well you're integrated. But if you, to an extent, of course, if you're in the smaller space, you really need to be part of what they do because they don't have this sort of massive internal expertise to deal with the payments, to deal with the checkout experience, to deal with all the necessary integration, and also to deal with the risk management and to deal with funding. So there are a lot of different tasks. And that's where we come from. So coming from a
So, so it's an underserved market that you're targeting.
it's an underserved market, and the market that really values efficiency and values
Mhm.
convenience of
So
this.
let's talk about the tech part of the fintech. I
Mhm.
mean, which is always the usually the interesting part of any fintech organization. So to what extent is the technology you're using helping you to get into this market and giving you, let's say, maybe giving you a competitive edge or advantage?
First, I want to really compliment our tech team because I think we have some of the really best people, within the industry in terms of development of technology. And when we say about technology, that are parts that matter the most, and there are parts that are important but matter less. So one thing that we are very, very focused is a balance between getting a very good user experience and at the same time having a prudent risk management. And again, we start looking at this, and we need to see what stage we are entering, because most of the finances enter when somebody already done the invoice, and then they sort of buying it at a later stage, and it's all disconnected and from different parts. For us, we integrate with the checkout experience. We are creating a portal for the buyer, we are creating a portal for the seller. We get people being able to seamlessly go and do things on our platform while doing their business, while operating what they need. And that, I think, is a big differentiation, and that's something that making the customer experience much more efficient. Now, the question you have with any technology is that you want to have efficiency not at the cost of not being prudent, not at the cost of things slipping through. And in designing technology, you really need to understand exactly customer pains, and you also need to understand the risk. And what you need to do, and that's a big part of a product work. You need to balance between the two and create an efficient customer experience while managing risk in an efficient way as well.
So your technology effectively enables you to be much closer to your clients in terms of what they're doing, their operational aspects, and you're much closer as opposed to being at more of a distance as some of the more traditional structures and larger structures perhaps are.
Absolutely. And then there are a lot of integration. So you need to have ability. And again, with integration, you need to be highly efficient, because we are not a bank that will do a massive integration that you do once and you do billions and billions through one of them. They're all relatively small companies. So you really need to be very, very efficient to be able to do it while serving, this sort of smaller companies. There is a good market. There are a lot of money, that needed there, but you really need to have efficiency, and that to me is the biggest thing, because people talk about all the fancy words in technology, and I'm not in any way dismissing them, and for sure we use several cutting edge technologies within what we have, but to me, our ability to integrate is the most important one, and the same apply to various other providers. So even look at the payment space that we, by the way, integrate. We provide, on the checkout, we deal with this as well. You look at the way we assess the risk. We look at the way we get information. We get all of this being done using some layers of technology that allow to efficient to capture it, efficient to originate transactions. We on the checkout, we can even produce, we can do e-invoicing, we can do other things. So we can, again, depending on the customer, depending on the degree of integration they need, there are a lot of things that happen. And if you look at the value, it creates a lot of value, because on top of a financing, we try to make customer process more efficient and less efficient. Because one of the biggest complaints about, the financing industry was it creates a lot of additional work as opposed to helping in the work we do. We are trying to balance the two. We are trying to make sure the processes we are running are helping customer in doing that.
Sure, and you're clearly taking quite a tailored approach as well,
Yeah.
to individual customers. So let's get back to the main announcement. The seed capital of $11 million and your $100 million credit line. What are you going to do with that money? How's that going to? What difference is that going to make to 40Cs in the coming months and beyond, in terms of your development and your growth potential, the sort of clients that you'll be able to target? What difference is this going to make?
Now let's speak separately about the two parts. The credit lines here is extremely important part of it, because obviously it's close to impossible for any platform to finance sales based on equity. It just, return on equity expected by investors is obviously much higher than any financing you can do on the market. So you need to have a debt financing. So you have effectively four ways of doing it. You can do it through P2P, trying to place individual ones. It's very, very difficult to scale. and it's not sustainable. And we saw even platforms that started this way go into some lines from a bigger sort of providers. You can go to a bank or non-bank institutions like funds or banks to do it. Or what we get in our case, you get it from a partner who understands the industry and who can also help and who have a strategic partnership, such as in our case. That, in our view, is a great thing as it's gone far beyond money. But it's obviously important because that allows us to scale. In terms of equity, everybody will tell you more or less the same story. It would not be fundamentally different. In our case, it's of course kind of specific. So what do you use money? You use it to build efficient technology. You use it to hire the best people. You use it for marketing. You use it for all the different things you need to do. Now, we are already doing a lot of things. So we are building, for example, our team in China. We are building our developers teams. We are building a number of functions within the company. So we are quite actively investing in building a scalable business. And in many cases, we are trying, and scalability is important because, again, I am not the most technical guy, but there is a term named technical debt when you effectively build something that is not scalable and that at some point need to replace everything. We are trying to an extent build things that are scalable, and that's very, very important. So we look very, very careful at the fact that systems will be very robust. We are looking very careful at the way that we provide user experience. We are very customer focused. We try to go service and great quality of service. And we obviously built in the teams that are close to the customers that can help them and guide them.
And just very briefly, Igor, what's your geographic targets and reach for the company in terms of where you see your clients, where your clients might be?
Where we started is mainly a corridor between China and North America. So China to US, China to Canada. And again, on both sides, we expanded. So we are definitely to identify a number of other supplier markets in Asia, but in the longer term also in many other countries that we are looking. We also looking already at a number of markets, including Europe, and we also looking to expand. So I would say Asia to North America remains core for us, but we are looking to do transactions in more places, and we built in all the necessary facilities to do it in more places, including UK.
Okay. Sounds exciting stuff. Igor Zaks, co-founder and chief risk officer at 40Cs, thank you very much for your time, and good luck with your new financing.
Thank you.